Thanks for joining us today on Market Call. I'm Morella Fernandez. We have Greg Newman on the show, Senior Wealth Advisor, Portfolio Manager, Newman Group, ScotiaMcLeod. He'll take your questions today on North American Equities, and here is how to ask those questions. 1-855-326-6266 and Market Call at BNNBloomberg.ca if you would like to email your question in. Greg, good to see you. Thanks for coming in.
Morella, great to be here. How are you?
I'm good. Jerome Powell is finally, somewhat in the clear. The DOJ has dropped its case against him.
Yes.
So Kevin Warsh now likely will have a smooth path ahead to the job. However, can you see him cutting rates considering what's going on?
Wow, what a great question. So first of all, I think that, Kevin is significant because he's going to embark on an experiment, which is really to shrink the balance sheet, right, of the United States. And that has, a lot of people have different opinions about that balance sheet, but, I was really around in 2008 when it was a very, very scary world. And we were fighting deflation. And deflation is the kind of thing that if you get wrong, you can be in the 30s. So you don't want to get that wrong. So that balance sheet kind of rescued us from that. And that was an innovation of Ben Bernanke. So he believes that the path to lower interest rates is a smaller balance sheet. And he also believes that these great productivity gains that we're seeing through AI are deflationary. I think he's going to be right on both of those. However, the wild card here right now is what is the price of oil going to do over the next 3 months, over the next 6 months, over the next year. And if oil prices are too high, then no, he's not going to be lowering rates, even though, of course, Trump wants him to. But it's much more important for the Federal Reserve and the integrity of the United States that this guy maintains his independence. And you know what? I think that the checks and balances are there, and I think that he will. I think that the market, what we're seeing now is this great run, on earnings, even though there's uncertainty about oil and there is uncertainty about the interest rate outlook.
I was going to say, do you think investors are ignoring what are the likely fallout effects, I'll say, of longer lasting energy prices?
I don't think so. I think investors are looking through, and what they're saying is that despite what you hear in the media, a bit of a checkmate that has gone on. And yes, the Strait of Hormuz might be not what it was 3 months ago, but it's an illusion that it ever really was that long term because Iran always could control that. And if they had a nuke, that wouldn't be a good scenario for anything, including the Strait as well. So I think the bet is that the Strait will improve. I don't think it's going to probably be what it was for quite some time, but I don't know that it completely has to. I think that as long as you can move some traffic, then combined with SPRs, combined with other drilling, combined with everything else, if we can have oil that stays around here, I think that that's probably okay enough for the economy to be
North
okay.
Americans will manage with what there is.
Well, not just that, but global. If global energy prices can stay around these levels, then I think that the economy is okay. We've been here before, and we've been at higher prices. If they go to $170, that's a totally different matter. That is something that is probably going to have a slower growth, recessionary impact. And so, but I think what you're seeing now is investors saying it's probably not going to happen.
Let's take a quick break. We will line up the first phone calls for Greg Newman, Newman Group, ScotiaMcLeod. Again, he's taking your questions on North American Equities. Here is the phone number to reach us. Back in just a moment. Welcome back, and thanks for joining us. We're going to start with an email from Paul. He says, your thoughts on Telesat would be appreciated. We'll throw this one over to Greg Newman. Do you have thoughts on Telesat?
This is not a very well-covered stock. There's only 2 analysts that cover it. It's not very liquid. Of course, global satellite provider. I think 51% of their business is in Canada, 32% in the U.S. The balance is basically Europe, South America, and Australia. When I look at the analysts, what they say, they model a pretty big earnings drop from here, kind of erratic and bumpy. it's a meritorious business, but for me, looks a little speculative. I like, a clearer earnings profile and something that trades at, a tighter PE that I can kind of see over a forecast horizon. So it might be a very meritorious name, but I don't like the risk reward. So we're not in it.
All right. That was for Paul. Let's go to our next caller, Elliot in Hamilton, Ontario. Elliot, go ahead.
Good afternoon. Citigroup has had a nice run. Is it now fully valued, or do you see there's still more room for share appreciation? Thank you.
Thank you for the phone call. Citigroup has a good run-up. Do you see more growth ahead for them?
My goodness, what a great question. Yes, this has been a top pick, and it's maybe gotten a little bit over its skis, but you got to look at Q4 that they just had. Their earnings were up 56%. They're on track. This has been an improving story on tangible common equity. This has not been in JP Morgan and the way that they've run their business. So they've really come a long way. They're in the final phase of their divestitures. Their global imprint is getting a little bit smaller. Of course, they're a little bit concerned about the macro, like all the banks here, but their return on common equity, tangible common equity, has improved to about 13.1%. Investment banking was up 17, equities were up 39, fixed income was up 13. Very, very impressive. Shake it all out, still 11% growth profile, compounded annually, and trading around 9 times 2028. On a 27, little less. Listen, so the bottom line is I wouldn't be buying it on the spike right now, but yeah, we're still owning it. And if you can get it around $118, I'd be buying more.
So a $10 drop from where it is today.
Yeah.
Let's get to the next caller then. Ryan's on the line. He's in Calgary with a question today. Ryan, go ahead.
Hi, Greg. I would like your opinion on Dollarama. It's pulled back a little bit here of late, and just wondering your thoughts. Thank you.
Dollarama, are there valuation concerns with Dollarama? I know they are growing, but generally speaking?
I think that's a great question. This is a very high multiple stock. This is trading at around 30 times. Analysts are sniffing around and saying, I think that they're down maybe 16% year to date. That's a lot. Should we be coming in? I think the culprit was their same-store sales miss. They had a softer guide last quarter. 4% earnings per share reduction from what the analyst community was thinking. I think they were guiding to a little bit softer margins as well. This is a great moneymaker over the long term. They're going to probably do really well in Mexico. We think that their Mexico enterprise can surface about $30 a share over the next 10 years. That said, what troubles me is that they're growing around 13% and trading at 30 times. And I still, from a risk-reward perspective, I don't love it here. So, yeah, I've owned this name when at a PAG ratio closer to 1. It was a top pick of mine years ago, maybe around $40 or $50. But at these levels, it's quality. It reminds me of a Costco. It can do okay. I think that there's better out there.
Okay, that was for Ryan. Let's move on to the next caller. Then John is on the line. He's in Milford, Ontario. John, go ahead.
Good day. Greg, I would like your thoughts on the overall question on the banks going forward. 3 weeks ago, I bought some more National Bank in Montreal, and I'm up pretty big on 3 weeks on it. And I actually took 20% of profits off. If they keep going up, would you take another 20% off? Thank you very much. Bye.
Thank you for the question. Would you trim?
Oh, my goodness, what a great question. Listen, do you own this in a non-registered account? Are you going to be paying tax on it? The banks, they're totally a different game than they were 2 years ago. They used to be stuck around, a 12.5 forward multiple. Now they're hovering around 14.5. They've just broken out of this range. So that's a great question. Where do you start taking profits? The fundamentals, despite some trouble with the housing market and loans, the fundamentals continue to improve. Balance sheet continues to improve. Macro is looking pretty good. I think National is one of the sweet ones with a real nice growth rate at a reasonable valuation. Would I buy more banks at this level right now? Yeah, we are. Would I sell National? It depends on the size of the position. I'd be more of a buyer. To answer the question this way, with fresh capital, I'd be more of a buyer than a seller.
A quick question regarding AI, because we know a lot of the financials are going to start rolling out the AI in the back room, taking over some of those processes. So I'm just wondering if you see sort of an extra sort of money-making push there if they start laying people off, the way we are seeing in some of the technology stocks, right? They're laying people off because they can do more with less.
Well, that's a great question. That's a challenge that we're talking about for the future, and it's an opportunity for investors. And it's this, Main Street versus Wall Street, Bay Street kind of argument. Yeah, I mean, I think that the market is seeing a lot of extra AI productivity in, financials and a lot of companies. And that's one of the reasons why it's another one of the bullish theses out there, why markets are kind of defying expectations here. Here we are in a war. Here we are with $95 oil, maybe going higher. How come these markets are still up? Well, that's one of the reasons.
Tech and AI.
Yeah.
Okay.
Yeah.
Let's get to the next caller. Evie is on the line. She's in Edmonton. Evie, go ahead.
Yes. My question to you, sir, is, are oil companies able to take advantage of the current high prices by hedging their production? And would you invest in an oil stock today for a 5-year time horizon? Thank you so much.
Thank you for the question. Two-part question there. Thoughts on hedging?
Yeah, well, certainly they can take advantage of, hedging in the market right now. Maybe there's a lot of common sense in doing that. I mean, this has been a bit of a bird in the hand that I guess oil companies weren't thinking about, 3 months ago. So, yeah, I would expect that a lot of them are considering doing that. In terms of buying the oil complex now, yeah, I mean, if the thesis is that oil is going to drop down to $60 right away, then I probably wouldn't be buying right now. But if your thesis is, as mine is, that Strait of Hormuz is going to be challenged, it's going to take some time. You're going to get some traffic through, but not 100% of what you had. And we're probably looking at $80 to $90 oil. Canadian oil companies are at a massive advantage because they underbuilt, they underdid everything for years. We're really trying to get it, to market and expand our markets. So, I think that Canadian ones, CNQ, Affinitive, look very good to me. On the natural gas side, I like Tourmaline, I like Peyto.
But you would still wait for a little bit of a pullback before buying?
No. I mean, I think that if you don't have oils, if you have oils in your portfolio, don't buy here. If you don't have any oils in your portfolio for a 5-year time horizon, I mean, I don't know about the next 3 months, but I think CNQ is a fine buy here, as is Affinitive.
Let's take a quick break on that note. We're going to be back with Greg Newman to answer your questions on North American equities. Stay tuned. Welcome back, and thank you for joining us. We're going to an email today right now from Chris. He says, I'm wondering why a TRP dropped $6 in the last 5 days. We'll pull up the chart and have a look and get Greg Newman here to weigh in on that. So this is TC Energy, and it is down when, of course, energy stocks have been moving up. What's your read on this?
Oh, geez. All you got to do is look at the sector. You had a possible deal with Iran. And once that happened, then you saw the whole complex do similar price action. I think, Enbridge, Pembina, Keyera, all had similar type of price action around that time. So, also the area was at a high. I mean, this is not just an oil play. This is an energy infrastructure play. This is a great company. Project outlook backlog is looking very visible. They got $8 billion in projects that are probably going to be sanctioned, 90%, another $12 billion that are being discussed. So there's really good growth there. And 26 is a high catalyst rich year, very attractive business mix, very mixed, very highly contracted asset base, does warrant a premium, but it does trade at a premium, trades at 20 times. So 20 times and 5% growth. And you expect some hiccups and when and some money to come off. So when you have a chart like that, that's going to happen. So nothing wrong with the company other than the fact that it's a little bit expensive. Would I put a new position in it right now? I think there's other places that are better in energy.
But if you already held it, you'd hang on.
Yeah, yes.
Let's get to the phone lines. And Elizabeth is on the line in Edmonton. Elizabeth, go ahead.
Good morning. I'd like Greg's opinion on Abex Technologies, and what's it? Is it a hold, or is it really too speculative?
Thank you for the question. Abex is a fintech company.
Yeah.
So they do sort of software, communication, a bunch of other things. Is it seen as more of a speculative play?
Oh, this is for sure a speculative company, but is it meritorious? I think it is. You know, I met with these guys when they were doing their Bay Street Roadshow a few years ago, and the stock couldn't get out of its way. It was maybe $5, $6. The fellows that are in there, Josh Crum, Goldman guys, they know what they're doing. These guys are very, very serious, and they're developing basically commodity markets, new trading markets like green energy and other things that weren't available, and it's becoming a bit of an AI play as well. So it's not a widely held stock. It's very thin. Little bit of price action moves it a lot. Stock has come, in those 2 years from 5 to
53 now.
53. I own it, but only for speculative positions, only in a non-registered account. Do I think it could go higher? And it's a great story. Yeah, but this is a speculative stock.
Let's go back to the phone lines, and we've got on the line Jim in Brooklyn, Ontario. Jim, go ahead.
Oh, hi, good afternoon. Greg, I know you just briefly touched on C&Q there when you were talking about oil, but, I'm just looking here, a little bit of a pullback in the last month, almost 10%. So I believe you said this would still be a good time to buy. I mean, it's obviously a very high-quality stock, so maybe your thoughts there.
Yeah, I mean, it's a little bit expensive relative to its peers. 8 times versus 7 times. Balance sheet's in good shape. 1 times debt to cash flow, 2027. Q4 was very strong, beat by 7%, 1% production beat as well. They increased their dividend by 6.4%. Yeah, these guys are going to pay you really well to wait. If you don't have enough, there's... I like them. Solid operational performance, enhanced shareholder returns coming, especially with oil at these levels. Look, I think you're going to do fine if you buy it. If you don't have enough oils, you can buy this position now.
You wouldn't wait for a further pullback. You're okay with buying it where it is today?
I guess listen, you can always get something almost always you can get something for a better price. But the problem is with that is that you're not going to buy enough of it, and you're not going to probably get it at that level. So many times you just miss things that are fair value. This is a fair value, meritorious name that really works if oil goes below $50 even. And if oil, stays where it is, it's doing really, really well. So with that dividend and with a 5-year time horizon, I think it's fine to buy it now.
Okay, that was for Jim. Let's go to Jason. Do we have Jason on the line? Jason, go ahead with your question.
Yes, asking about SOXX Semiconductor ETF. I see them all going parabolic. I'd like to get in on some of this action. Is this a good way to play it?
Well, this is the 18th day in a row that this ETF is up. These are the semiconductors. Mm-hmm. When you have price action like that, you got to be careful. And everybody's coming out. Intel just came out. Taiwan Semi.
A bunch of them coming out next week.
They're all coming out on Wednesday. Well, a lot of them are. And I think people really misjudged the demand. Yeah. And I think that they were wrong. And this is what you see. So you see this very powerful move. Straight up, look, there is another side of the mountain. Do you have 5 more trading days like this where it's going to go higher? Maybe. You need one earnings report for it to fall 6%, 8%. I think you're identifying a great asset that we want to own, but at these levels, I wouldn't be adding right now. No.
And just out of curiosity, this is all the big players for chips?
Yeah, this is your main basically go-to if you want to buy them all together in the United States probably the most liquid ETF there is, the SOXX. It's the benchmark that everybody looks at for how are this one-stop shop for how are the semis doing.
On that note, we'll take a quick break. We're going to have a look at Greg's past picks when we come back. We're going to go through some past picks now from Greg Newman from April 25th, 2025. So a year ago. At the time, Greg, you chose Power Core, POW on the TSX, 50.80 at that point, 72.78 today. So 43% upside, 48% total return. They're sort of a holding management company. Do you remember why you picked Power Core last year?
Yeah, great combination of value, growth at a reasonable price. Maybe not its total asset being valued appropriately. I mean, people look at it for Great-West Life and Mackenzie, Investors Group Mackenzie, and of course, they've done pretty well. But they've got these stub assets like Wealthsimple and Rockefeller that continue to surface value that people really weren't paying attention to, that wasn't really being ascribed. So it was that. It was, tethered to all the things that we still like now, which is that, it's growing at 11% compound and nothing wrong with that, and trading at 11 times 2027. Throw on that good dividend that tends to go up, and their net asset value was up 46% in Q4. I think the thesis is playing out, but there's more to go. So I'd be adding to it now.
That was Power Core. Let's get to your next past pick, Brookfield Infrastructure, BIP-UN. It was $39.97 at that point, now to $49.11. So 23% upside, 29% for total return. What do you like about the infrastructure play for Brookfield?
Well, so much of their infrastructure, but they're also getting into data operations and AI infrastructure, which is very nice. And they do a lot of capital recycling, but these guys they're in indexed and inflation-linked revenues that just go up no matter what the environment. And, they pay you really well to wait. And again, like Power, it's priced at a really nice multiple. It's 11 times, still 2027 price to adjusted funds with 11% growth rate. Nice distribution that the management wants to boost every year. I think that there's multiple expansion that this name can have as they prove their thesis out further, but it's an excellent management team, and I think this is a mainstay that you should have in your portfolio.
Brookfield Infrastructure there. Let's get to your next past pick, which is Keyera, KEY on the TSX. So 42.62 at the time to 50.10 today, 18% upside, 23% for total return. Are you still invested in Keyera?
Yeah, and you know what? If we were just talking about TransCanada Pipelines, then which names would I be buying now? This would probably be the first name that I'd be buying. They just beat last quarter. Their liquids gathering and processing beat. They're buying new plants that look accretive. They got a Plains transaction that's probably going to happen. That is another catalyst for the stock. If you're looking for cheaper name relative to its peers. We just talked about TransCanada around 20 times. These guys are around 16 times, actually 15.5, and growing at around 18% here. So still the darling, I think. And meantime, you do get paid this nice dividend as well. So all in, I think money should still be going into Keyera.
Keyera it is. Let's take a quick break on that note. Coming back to your phone calls for Greg Newman in just a moment. Stay tuned. Welcome back to Market Call. Richard has been holding on the line. He's in Richmond, BC. Richard, go ahead.
Oh, hi. Yes, Greg, I would just like to ask you about Taiwan Semi. I just a couple of days ago it went up. I have some of that. It went up $19, and now today I see it's gone up over $20, and I just wonder what you would do with it.
Thank you for the question. Would you trim for Taiwan, or would you just hang on?
So all in, I would trim, as long as I wasn't in an adverse tax position. Look, they had a great quarter just recently. The revenues were up 35%. Companies saying they're seeing increasing demand from their advanced semis, from Apple and Nvidia, names like that. But it is a little pricey. It's not cheap, around 18 times 2028, and only growing around 9 or 10%. All in, I would enjoy a little bit of this and do some profit taking on it.
That was for Richard. Let's go to Harry on the line with the next question coming out of Kelowna, BC. Harry, go ahead.
Thanks very much for taking my call. Yeah, Greg, earlier in the year, you had recommended Telus as one of your favorites. They're obviously having a bit of a rough time now. I'm just wondering what your long-term prognosis might be on Telus and how safe your dividend is. Thank you very much.
Thank you for that question, Harry. A lot of people worried about that dividend. There is a new CEO at Victor. Telus, and there are concerns it'll be cut. Do you think it will be?
I think it probably will be. And the caller's right. I did like this at the start of the year. My assumptions were with any stock. Honestly, the biggest conviction you could ever really have is maybe 90%. And you're basing it on all these different assumptions. And some of those assumptions don't happen. And one of the things that we thought was that they're going to see, an uptick in wireless and a less competitive landscape. And that just hasn't happened. So then you got to say, from your A thesis to your B thesis. Given everything now, do we still like Telus? Yeah, Intel is an example, was a top pick of ours, at around $35. Of course, it wasn't a straight line, and it went to, it killed us, 20, and now here it is. So, you gotta understand and say, okay, is this exactly what I thought in December? No, but is it still 80%? If it's not 90%, you can trim it, maybe down some, 10% down to 80. But I still like it. All in, yes, Darren's going to come. Victor's going to come in. He's going to probably clean house. He's probably going to cut their dividend. I think the stock kind of can rally. I think you're going to see some innovation with the company like we just saw with, Rogers recently. I think that the future for these companies is to, with the regulatory environment as it is, and mobile, MVNOs, they gotta do CapEx cuts. So you're going to see that, and the stock's going to rally. And anybody that held it is going to be accumulating this really nice dividend. It's going to probably shrink, but it's still going to be a nice dividend thereafter. And if you play it properly over 3, 4, 5 years, you're going to end up making money on this, even from the December call. So you can't. It's okay to not have things always be winning in your portfolio, and sometimes, when they're not, it's a real sign that you got to take action, and other times it's not.
Let's go to the next caller then. We have Ron on the line. He is calling us today from Edmonton. Ron, go ahead.
Okay, thanks for taking my call, Greg. You could take a look at Cameco for an ad the next 1 to 3 years, and if you have any insight on the supply demand on uranium itself, that'd be appreciated.
Thank you for the question. So when the whole energy discussion and the need for the build-out started, uranium sort of shot through the roof. People were like, okay, we need the energy. And then people kind of realized uranium's not going to be needed for a little while because the build-out hasn't happened yet to make use of it.
Yep.
It's at 123 today, 169 here in Toronto. Would you dip into
so we owned it, and when this was like $20s, $30, $40, we were excited and we were buying, and of course it also got a boost from the Russia war, Ukraine, and so that's a risk if there's ever peace there. Goodness, so we hope there's peace, but. They beat last quarter, well above, but their guide was a little bit lower. They got a very attractive multi-year outlook, but are you at a level that you should be buying it? I mean, it is growing at 40%. That's a big number, but it is trading around 75 times 2027. I see better value in, so I'm not adding new money. But look, people that need uranium, there aren't too many quality choices. So a lot of stocks trade at premiums for these reasons. But I like things that are more hinged just to the math. Particularly when we're in a world where things can change quickly. I mean, I remember this was the darling in 08 or 11 or whatever, and then we had the accident in I think the Fukushima plant in Japan, and that changed its outcome. And then you had problems with Cigar Lake for years. So you got to have respect for stock prices. They overdo it both ways, right, and to the extremes. And I wouldn't be buying it here.
That was for Ron. Let's get to Kate on the line in Toronto. Kate, go ahead.
Well, thank you both for taking the call. My question is on gold, the commodity. Greg, in your opinion, what price do you think the gold could go up to, and by when? And the other side of it, how much will it go down, and by when? Thanks very much.
Okay, so some pretty specific forecasting for you. So it
Crystal
is
ball.
This is the June contract we've got up at 47.41 today.
Right. So look, I'll tell you what the bulls are saying. The bulls say that this rally is going to continue. The central banks are net buyers. You got democratization of gold products. Where individuals can get at it. And that investors were so underweight, and that's going to continue to drive. And as people become less fans of the United States, maybe they're going to continue to diversify to gold. This is what the bulls are saying. Gold, if you look historically, you've had 6 main cycles over the last 50 years, and they all follow like a shock, like an oil shock, similar pandemic shock that we've had here. So the bulls will say that it has legs. I think that maybe you're seeing one of the reasons why it's come off here is the smaller balance sheet of the United States. And I think gold has to be nervous of that. The trouble with calling gold is that you are not really forecasting supply and demand like you are with anything else. You are forecasting investor appetite for gold, which is very fickle and can change very, very quickly. And it's kind of similar to like a Bitcoin thesis. It's just, what do people think it's going to be worth? Now, this has been around for thousands of years, unlike Bitcoin. So there's merits to holding gold. But would I be buying it here for diversification if you don't have enough? Yes. Do I think gold is really going to lead your portfolio higher here? I don't. I don't think it's going to do the heavy lifting, but it could. It could. And but it's just more speculative to call something like that.
Let's take a quick break, then we'll get back to more of your phone calls in just a moment. Welcome back. We have an email from Chris saying, what's your long-term outlook for Pembina Pipelines, and what do you think about Apollo buying a 40% stake in Pembina's gas infrastructure? What did you think of that deal first? Let's start there.
Well, I think, Apollo, these guys are smart guys. And, that's a pretty meritorious stock that has had a hard time. The private equity stocks, trading around 12 times with a 9% growth rate, not bad. They're smart, and they're seeing opportunity here. Of course, I think they're just buying it from KKR. So from Pembina's perspective, other guys that are also smart thought that, they were a good asset. As to the merits of Pembina, a little bit expensive, but growth catalyst there, growing around 5 to 7%, trading a little bit expensive, but there's some really nice visible project backlog, and there's probably growth at Yellowhead Alliance this year. It's not as favorable as Keyera, in my opinion. It's something more like TransCanada Pipelines, but nice dividend, and you're going to do okay if you own it. Would I add to it right here? No, I'd add to Keyera, but if you got it, hold it.
Let's go to the next caller then, which is Andy. Andy's in St. John, Newfoundland. Andy, what's your question today?
Thanks for taking my call. My question to Greg is about the Mag 7. Which one would he pick up now? And would he buy it in U.S. or CDR in Canada?
Oh, I like that question. That's
okay,
good.
so a couple of things there. We've been talking on and off about who's benefiting from AI build-out, who's going to win that race.
Yep.
They're all kind of employing AI differently or benefiting from this race a little differently.
Yeah.
Who are the front runners right now?
Oh, gosh. Well, they're always trading. Right now, Microsoft's not. And, the OpenAI is perceived as not being as good as Anthropic. Mm-hmm. But they're always innovating and they're always changing horses. And so they're all pretty good. And the thing is that, on the show a couple months ago, when I can't see a difference and they're all just really good like they were a month ago when this tech sector was just sold off and something was wrong, it was just just buy them all, And so would you buy the QQQs or would you buy the XQQ, which is hedged? I think, guys, seriously, unless you got U.S. money, buy the hedge because I think the Canadian dollar has got more upside than downside over the next 30 years, over the next 5 years, over the next 10 years. And if you got to fight a currency headwind of, getting to 90 cents or 95 or par, it's tough. So buy the hedged one. In terms of the best of the seven, before Nvidia exploded, now it's 208.
Mm-hmm.
It was that. Probably still is that, actually. It's probably still the most compelling. But I like Meta here. I like the fact that Meta has come down a lot for reasons that investors understand, which is, lawsuits and huge CapEx. But I think it's gotten to a level that it's underappreciated. And I think investors are going to do well by buying that one right now.
So we talked about Nvidia running up, and it's at an all-time high now at 208. So you wouldn't pick it up where it is today, obviously.
Well, listen, it depends how cute if you don't have any Nvidia and you're deploying fresh cash into the market, look, you're going to get a better price probably by waiting, a couple days or a couple weeks. But better to own it here than to miss it, $20 lower because it's going higher.
That is. Sorry, let's get to our next guest then. Paul's on the line, is in Victoria, British Columbia, with his question. Paul, go ahead.
Hi there. Great show, Marilla. You do a fantastic job.
Thank you.
My question is on Alamos Gold. If gold stays range-bound 4,000 to the current price, how do you feel about Alamos, or do you have a preferred play in the sector? Thank you.
It's a good play. It's a good play. We're looking for gold companies that are pretty reasonable. This one is 15 times 2026. As long as they continue, their exploration results have been really good. Lynn Lake, they've got a lot of irons in the fire. And, we do see reserve growth and resource growth. 87% earnings per share growth over the last couple of years. So, I think that the sector sold off a little bit. And if you're looking for a good gold play within the sector, I think Alamos is one of them.
Let's take a quick break then. We will have new picks coming up from Greg Newman when we come back. Stay tuned. Join us Monday for Market Call. Richard Fogler on the show. He is managing director at King West & Company, and he will take your questions on North American Equities. And if you missed Market Call, check out our daily podcast. Find it on iHeartRadio and other platforms. You can also watch full episodes on our YouTube channel. Let's get to some new top picks from Greg. South Bow is where we'll start, SOBO on the TSX in the energy space.
Yeah.
Why this one?
Well, I think this is, even though they're not throwing the word around, this is to me like a Keystone Part 2. Not exact same, but some of those assets. This really is a play on moving oil from Canada to the United States through their Prairie Connector. It might not happen. It's a risky endeavor. They need partners and backstops, but it's not in our numbers now. It does represent $5 of upside if it does happen. But this is a nervous market, and we don't know what oil prices are going to do, but you're getting 6%. Meanwhile, last quarter was in line. They reiterated their guide. Their balance sheet is improving. I think if Canada doesn't decide to put oil from now or, to the U.S. more, I think the argument is now or never. So I do think that it's more likely to happen with this government right now and nation building. So, 25% growth rate and 15 times 2027, good risk reward.
And high dividend. You mentioned that, but that's a pretty high dividend for people who want to wait.
Yeah, beautiful dividend. Now, it's a high payout ratio as well, but it's very highly contracted. I don't think it's going to hurt you long term, and I do see some upside here.
That was South Bow. Let's get to your next pick, which we touched on a little bit, was Meta Platforms in the tech space. You like Meta above some of the others. Why?
Only because where it's at and how it's fallen this year. Why did it fall? Eye-popping AI concerns, with the other guys. Legal challenges like child safety issues. These are real. This is something that, companies got to address. The whole tech sector had its swoon. Yesterday, they just cut 10% of their workforce. We were talking about, and they're scrapping plans to hire 6,000 more. It's necessary for them to invest more in generative AI. These are smart guys. Zuckerberg's a smart guy, and they're bolstering their position in AI. Stock is down a lot. I think the risk reward here looks very compelling. It's trading around 17 times and growing at 17%. So, risk reward perspective, I think this is your Mag 7 name that sets up best right now.
How concerned are you about the lawsuits, the ones that were decided in the U.S.? I mean, I know they'll be challenged and it'll make their way up to the Supreme Court at some point, but how concerned are you about the hit this company could take on?
Very, very. And I think that, it's like tobacco. I think that, it's something that they're going to have to get through. They have to account, and they're going to have to write some really big checks. And there's that uncertainty as well. But I think that that's in the stock at these levels.
Let's get your next pick then, which is Atkins Realis, ATRL on the TSX, well-known sort of infrastructure engineering firm. Why do you like it right now?
Well, I like where it is technically. It's hovering around its 200-day. I really want a company that's going to benefit from nation building, that benefits from nuclear, that's trading at a reasonable multiple with nice growth. Q4, I think, was the opportunity. They had some higher losses in one of their little divisions that's really only 60 to 90 cents per share, but the market made a bigger deal of it, masquerading the fact that this name has 5 to 7% good organic growth, book-to-bill ratio that looks really good, margin expansion at around 17.3, trading at around 18 times, growing at around 19%, very tethered on a price-to-growth basis. I think it's very reasonable at these levels. I think this is a good Canadian staple stock that should be owned here.
Let me ask you about how much you think they'll benefit from the infrastructure play just in Canada. Is that going to be a huge windfall for them?
That's part of it. I mean, Darlington, and yes, that is definitely part of the thesis of why you want to buy the E&C companies, period, and this one as well. So, and the other ones are Stantec and WSP, and they're meritorious, and they've been topics of mine at different times as well. But this one just looks better on a price to growth.
And so you'd put new money in today?
Yes, I would.
That was Atkins Realis. All right. We will leave it there. Greg Newman, thanks for coming in. Good to see you.
Thank you.
Have a good weekend.
Yeah, you too.
And thank you very much for joining us today on Market Call. We'll see you back here again on Monday.